Now, as we always go into segment two, we talk about the overall number. And this chart always looks at motor gasoline, jet fuel, distillate resid, because we want to look at mobility fuels and what are they doing overall. And obviously, when you look at that white chart, the white line, that one that has a huge amount of swings, that's the week by week. But when you look at the other white line, which we should probably change the color to make it a bit easier, you can see, or at least bold it. So you can see it just has been hanging out between 14.8, 14.9. And that's where we've been saying that we live is just below that 15 million barrel a day number, just because obviously distillate was coming down versus where it was in 2021. But gasoline was just going to be under pressure as we went through the summer just because of price. But then as price came down, we had been talking about the slowdown in the economy, the pressure that's putting on it, and how we're just not really seeing the same type of normal demand. Again, coming in at about 9.1 million barrels a day versus the normal 9.7, 9.8, which is, again, that delta that we've seen, which is keeping us a bit depressed. So current demand came in at 14.066 versus last week of 15.379. Now, it's important to highlight the 15.379 was wrong and the 14.066 is wrong. It's just lumpy. It has always been lumpy. It will always be lumpy. And that's where we continue to see the drive. But as we saw in the gasoline front, where it dropped below 2020 numbers, and we're saying, look, it's not below there. It's something above it. When you look at where 2020 sat at about 13.9, we're saying that we're probably 1 million barrels better than 2029, and then about 600,000 barrels worse than 2020. And I think that's what we're seeing right now when you look at the shift where we're not as bad as we were and we're not as good as we were. We're somewhere in the middle, closer towards normal, just because of some of the, people are still moving about. There's no restrictions. So the only restriction at this point is on a monetary basis. And when you're thinking, or I should say on a personal consumption level, based on where credit is, credit cards and the like, which we've been covering ad nauseum at this point in the Econ show. So then when we look at the distillate side, there was a small draw of 660,000 barrels. Definitely not what we needed at this point in time. You can see that we're now 35 million below the 5-year, but all of it is, again, weighted towards pad 1. Pad 1 is 22.6 million below the 5-year. Pad 1's the only place that had a build of 1.33, but it's a drop in the bucket unless we can see some real growth in that level. As we were saying, imports were going to remain elevated. They were up slightly by 8,000 barrels a day, driven by Pad 1 being up 11 and Pad 2 being up 11,000 barrels a day. But when you look at just the general chart, we are coming into bare bones level going into winter. So this is, again, a huge concern because we still consume a lot of heating oil during the winter months, especially in New England. So that's why when we talk so much about Pad 1, because of those issues in terms of where is their availability. And it's only going to get worse because trucking, even though trucking's come down, it's still elevated, and it competes directly now with heating oil. So when you look at, and again, it has competed in the past, it's just, I think it was 2014 and then 2014, 2016, 2018 is when the different votes were to bring down the sulfur content and adjust heating oil, which is what that comment was about. So diesel margins remain at record. The question is, can it stay elevated and offset some of the weakness that we've seen in the gasoline crack in the very, very near term? The answer is just yes. Low supplies are going to keep that supported. Diesel margins, FGE is saying that we could see $70 diesel margins. When you look at the crack, we're at 67.57. So again, to say that they could be at 70, I 100% agree with that. I don't see any reason why, especially as we go through go into the winter months. The biggest problem now is going to be the availability of distillate yielding crude, which is why we continue to get this broad disconnect between the different oils in the market, with anything yielding a high disti cut trading at a significant premium. Some Nigerian barrels that have a high distillate cut are now trading at a record just against the OSPs, just because of the need for distillate in the market. So pad 1, again, that build is a nice start, but you get an idea that the rate of change is still very low, and we have to see this huge pivot in order to get even remotely close, even just to the bottom of the cloud. And that's where we continue to see a lot of problems as we're preparing to head into the winter months. Then when you look at pad 3, fairly normal. Again, there's really not much up or down. The problem is Colonial Pipeline is tapped. We now have two Jones Act vessels that are moving gasoline into New York, but not seeing all too much Jones Act activity. Again, it's costly. It's a hindrance, so it still makes sense, because if you think about pad 3, they can export into the market, make a healthy premium, and then that'll help absorb some supply. I should say some demand. So then some of the new supply coming in from the Middle East, because the U.S. sent some to Europe, some of that can come into pad 1. Again, it's a very inefficient way to do it, but that's a way to kind of balance things in a very backwards, haphazard type of way. But again, you can you can see some of that coming through, but we're still at a lower end. Again, it's not like pad 3 is floating in it, but you're getting an idea that we're still above that 29-year average. Distillate demand, as we were saying, it's going to stay at the 5-year, just below the 5-year, and we do see that shifting a bit higher as we go into the winter months. But that's going to come down to Mother Nature. How quickly do we get fall coming in? How quickly do we get the first real freeze? And that'll be obviously a huge driver here. Trucking demand continued to come down. We're now at the top that we saw in 2018. So one of the things that we've been saying is a level off, because now as we start going into September and October, you start to get movements. First, we had movements for back to school. You can see that it was still, which again kept us still elevated. But now we come into the Christmas push, which is just going to keep us at these levels. We're not going back to a huge surge. There's still some pressure to the downside. But when you go back through history, going back through, again, 2014, we're still at a high end. So there's still consumption, but it's just not to where we were back at the beginning days of 2021 and throughout that year. And some of this is going onto rail. So when you look at it as people don't need things rapidly because inventories have caught up a bit, builds have come through, well, why not just wait to put stuff on rail? So chemicals, coal is going to stay strong. Farm products staying strong. Grain, no surprise there. Again, the thing that is going to continue to be some of that hindrance will be some of the intermodal. But as we were saying, it's just about 2 to 3% below last year. But still, if you think about last year, still elevated in general. So you're still seeing a lot of this. It's just the companies are going to rely a bit more on rail. Reduces the cost. You can put more loads than just one, which again is going to keep things a bit active on the rail front. As you can see here with just what is coming onto the coast, it continues to diminish, and that those headwinds are going to continue through September and into October, just against last year and against normal, just again as demand in just across the board starts to come down. U.S. gas, heat waves coming through. You can see pretty much everywhere except the South is going to be well above, either above or well above average. That's going to persist. That's going to keep natural gas demand fairly firm. But I don't know if you guys saw, Freeport had said that instead of coming back in October, it's going to come back in November. That dinged some of the natural gas numbers. But again, whether it comes back October 15th or November 15th, we're still going to have a huge demand going offshore. Obviously, big demand remains in the U.S., and that's going to keep us fairly firm on the nat gas front. Gasoline, A small draw of 3,000 barrels. Again, I'm sorry, 30,000 barrels, nothing crazy. The pad 1 had a build of 2.74. That's, again, some of those imports coming through, some of that slowing demand that we've been talking about. Not too much overall. Blending components, slightly better. Came down 890,000 barrels. Not too much in general. So again, nothing too crazy in that realm. So right now we're about 18.4 million below the 5-year. Some of that being driven by pad 1. Imports down 100,000 barrels a day. Pad 1 was down 163,000. That's timing. We will see that come back up. Not crazy, just we will see some of that reverse. But when you look at gasoline storage, as you can see, there's normally that downward trend, and we're just flatlining, and we expect to continue to be at a fairly flat and muted side. Then when you look at gasoline, looking at the different years, here you can see it's just we're sitting there. I don't see us going up or down much. Maybe we get one big week of an increase, but again, it's going to be something fairly flat as we go into September, and then we should start to see those storage building as we get past September 15th. September 18th and into the back half is where we'll start to see some of those increases as we come into the shoulder season. When we look at congestion and just activity, here you can see that China remains just above. In some areas it's steeply below. It's a fairly mixed grouping. So again, we do see some pressure in China. Google mobility, when you look at the world, it is now rolled over because Europe is pulled back, the Americas is flatlined, and Asia Pacific is starting to come down. And as we said before, we do expect to see Asia Pacific have a steeper drop. TomTom congestion, you can see that move lower in Europe, the move up in North America. As we come towards the end of the summer break, that's where you'll see the U.S. level off a bit, but Europe is going to remain under pressure, just given, again, pricing, just demand and overall, as Asia Pacific continues to dwindle a bit lower. So last week we had this going back to 2006. So not much has changed. You can, in your mind's eye, we're still at all-time highs, even compared to 2008. I want to zoom in a bit because you can see the flat line and actually the curl up. And diesel has actually stopped going down and is now going back up. One of the things that we had said a few months ago was that we expected diesel to come in, I should say, about 2 months ago, was that we expected diesel to flatline at about $5. And not because 5 is a magic number, but really because that was where we saw things leveling off. We thought crude over-exaggerated to the downside. We did see some upside in crude pricing, but the distillate pool hasn't changed. Demand is still high. Storage is still low. So again, we expected that flat line and just not a little bit of a curl up. And then here you can see just with gasoline, with oil prices going back up, the rate of change of gasoline prices have slowed. It will continue to get cheaper, especially as we come to the other side of Labor Day, where now you're allowed to run winter blend, which is a bit cheaper. That'll be a nice little drop, but you're still staying at a very elevated level, which is, even though it's come down, it has to put into perspective how much it's come down. Blending components, as we were saying before, down 890,000 barrels. And if you compare that to gasoline, which was only down 30, it just means that things should be, gasoline should have been down a little bit lower. But remember, there was the flip where gasoline dropped too much versus blending components, and ethanol had another build. So again, when you're looking at that blend, you're getting how we're at this kind of muted number in general when we look out over the next few weeks. Again, demand dropped too far. We don't think it was at this steep number of 8.4. We think it's below 9.1, something closer to 9 million. So you will get that bounce back next week. And here's when you look at, again, Google mobility. Everything's fairly flat, a little bit of a softness in some areas, a little bit of strength in others. not too much one way or the other. So again, one of the reasons why we still think we're fairly firm at that, just above 9 million barrels a day of gasoline. Propane, small build of 10,000. You can see here we're still below the 5-year. We're right kind of in that low point, and we expect to remain there as we go through the next few weeks. Jet, small drop of 430,000 barrels. That's 1.7 million below the 5-year. And you can see here that we've just leveling off in terms of demand. We do see a bit more downside. And the reason why is because, again, seasonally speaking, there's normally that drop off. And you can see that we're just following that drop off just above 2021 numbers, just below 2019 numbers. And we're just going to, again, settle out. So that'll pull down some of that additional demand, which is continued to be confirmed with future flights. Passenger flight schedule for the 12 weeks ahead is 0.59% lower, 59 basis points lower. We've gotten some more commentary in terms of just additional flows where more flights are getting cut. So again, just a bit more downside. And then when you look at open table, U.S. is fairly flat, and I think that's kind of where the rest of the world is going to go. Some of the reopenings skewed some of the numbers at the high end, but on a global level, we're still 5 to 6% better than normal. But in the Econ show, we're gonna talk about how that's coming under pressure, given some of those very, very elevated and healthy inflation numbers that are hitting Europe the hardest. And that's going to, again, result in some of these slowdowns as less people eat out. And that's going to be something to talk about and watch as we go through the end of the year. So that's what we have for you on the U.S. refined demand side. And now we are going into the, in the next segment, we're going to go deeper into what's happening in China and what is happening in the international markets.